Cool. Well, welcome everybody. It looks like folks are just starting to roll in. We are happy to host. We got both everyone who's in the crowd as well as folks who are watching this recorded. We're joined today by some really great minds who are at the cutting edge of knowledge and understanding when it comes to tax and law. I'll let everybody introduce himself. But again, thanks everyone for being here. We have Jason Klimek, we have Nick Agrippino, we got Eric Carbone on the call. This conversation will be featuring predominantly conversation between Jason and Nick, maybe a couple little tidbits from Eric and I from the peanut gallery. But yeah, Jason, I'd love for you to introduce yourself, and then after that, Nick, take it away, and then we can just begin this conversation around 280E and what that means and what we're moving towards.
Cool. Well, thank you, Zach, and thank you to the NYC GPA and the Education Committee for inviting us to speak. I'm Jason Klimek. I'm the Cannabis team co-leader at Barclay Damon. I'm a cannabis attorney as well as tax attorney. I also chair the policy committee at NYC GPA and work closely with NYC GPA, its members, and cannabis clients to, help in that area and make sure that this is a market that, New York intended for it to be.
How's it going, everyone? Yep, thanks everyone for having me. Nick Agrippino, tax manager here at Bowers & Company CPAs. I'm also the tax manager and cannabis hemp niche leader here at the firm. Also on the policy committee in some form. I don't know what my title is on that, but I'm on the calls. But yeah.
I'm Eric Carbone, co-chair of the Education Committee, along with Zach, co-founder and lead grow at Tricola Farms / Tricola Gardens, and co-founder and CEO of Bardo Labs. Just want to thank everybody for joining us. We're going to start off just kind of talking about little insight on 280E, and towards the end, we're going to open it up to a little bit of a Q&A session. We did have a question or two submitted via email on the questionnaire we sent out. So before we get into the Q&A later on, we're probably going to hit that. But I would imagine that question will be answered in the commentary throughout. So we'll see how much of that we cover. And if not, we can revisit that at the end. Thank you, guys. And thanks everybody for coming.
Yeah, we got that question right at the end of the slideshow. So I'm going to screen share here real quick to get started.
And if there are questions too, I think, can they submit them through the chat or the Q&A function?
Yeah, there's a Q&A function in the chat. That would probably be best. Zach and I will keep our eyes on those questions as we go along. If you guys happen to see one that pops up that's pertinent to what you're discussing at the moment, feel free to answer it. If not, though, we'll kind of hold off towards the end, I guess, for those.
Yes, and feel free to send in things, we like the interaction in the questions. So Nick and I were discussing this earlier, and the more interaction we have, the better this will be, I think, for everybody, because we can really help answer your questions, and it's more fun.
Yeah, we got a lot of good info on these slides, but we're going to try to blow through these to try to leave some time for Q&A at the end stuff too. All right, so let's get started. First, to start off, just standard disclosure, not legal or tax advice. This is for educational purposes only. No attorney-client privilege and stuff. So just a standard disclosure that, especially when you're talking about cannabis and tax law, there's a lot of gray area, a lot of difference of opinions, even among professionals. So take all of it with a grain of salt and consult your hired tax or accountant. And just general overview, we're going to start with excise taxes and the relevance around 280E. Brief 280E overview, get into the weeds on some of this stuff. Entity structure and considerations, and then just some miscellaneous stuff to consider, and then we'll open it up to Q&A.
Okay, So first, we'll just start off touching on the MRTA tax rates for those who are not familiar. So in general, they're going to be paid by the retailer to the distributor. A cultivator can also be a distributor, particularly for the conditional cultivators. You are distributors. In the future, when there is the micro business, everything will be collected at retail because there is no distribution. So they break it up. So New York State has one of the only, we actually don't have the only, Connecticut is also this way, THC potency tax, where New York taxes on a dollar amount per percentage point of THC. And they break it up into 3 different categories. So it's 0.5 cents per milligram of flower, 0.8 cents per milligram for concentrates, and 3 cents per milligram for edibles. So that is the basic tax rates for the excise tax that'll be paid again by the distributor, or paid by the retailer to the distributor. So cultivators don't actually pay this tax.
And Jason, just a clarification point, if a cultivator is selling their biomass to a processor, that's not the same. Are we interpreting that as a distributor, or are we saying distributor is who brings raw product or a product to a retailer? You know, how are you defining distributor here?
I believe the distributor is the one who ultimately sells it to retail.
Great. Yeah, I do as well. But I appreciate you clarifying that. Thank you.
And one more, just to clarify. So this year, since the AUCC license holders are able to self-distribute, we would be responsible for collecting those taxes on the flower.
Correct.
And yeah, all right. Just wanted to clear that up. Thank you.
If you
And
distribute it right to a retailer.
yeah, and for anybody who has, run a business or anything like that where they have to collect sales tax, same kind of thing. This is the government's money you're holding in trust. So it is really important that, everything is accounted for. You're collecting that tax, you're remitting it to the government, because the government does not like when you mess around with their money in particular. This is a little different than income taxes, where it sometimes is not, there's a little bit more leeway. They will come after people for this kind of stuff. So it's very important to be compliant.
Just to add to that too, penalties, 2 things you don't want to screw around with: sales taxes and payroll taxes. Penalties on those, you can be looking at those taxes doubling in a very short period of time. They're no joke.
Yep. We refer to it as the 100% penalty, and you'll be personally liable. I actually don't know off the top of my head if that's how these excise taxes work, but in the sales tax realm, it doesn't matter if you're sitting behind an entity, they can come pierce through the entity and come after you directly, which means your assets are on the table, like your house, your car. So again, very important that these are collected and remitted and done properly. Okay, and the next set of taxes is the ones at retail. So after the excise taxes are paid, once the consumer is buying the product, then instead of a sales tax, which, in New York averages around 8%, there's now instead, not in addition to, a 13% tax. And it's broken up. 9 goes right to the state, 4% stays local. And then of that 4%, 1% goes to the county, 3% is split pro rata to the municipalities that have not opted out. So for example, if you had 2 municipalities, one did, call it $1 million of revenue, one did $2 million of revenue, the one that got $2 million would get 2%, the one that got $1 million would get 1%. As I said, it is exempted under the sales tax law, so it's not 13% plus 8%, for example. And then there was just a question that arose: do you have to include, if it's a vapor product, do you have to include the 20% additional sales tax? No. In the law, it explicitly exempts adult use cannabis that's taxed under the cannabis tax law. So you do not have to include a 20% tax on the vaporizer sales. So New York giving a little break there. Okay, so potential issues. Regulators have said that they prefer a THC or a weight-based tax, which was actually the proposed tax before the THC one, over an excise tax because it operates independently of price. So what they're very concerned about is that the market, the sale price of cannabis at wholesale continues to go down, and they make less tax revenue off of that. There is economic data that pretty much unequivocally shows that for every 1% decrease in price, there's a 2% increase in sale. So their fears may be unfounded, but that is the rationale, or at least part of the rationale. Part of the problem is that this creates an artificial price floor. So we saw this out in California, where prices of cannabis were dropping down to like $300-400 a pound. And then you had excise taxes, they do a weight-based tax there, of like $150. So you had like an excise tax that was equating to about 50% of the price of the cannabis at wholesale. And that just leads to illicit market proliferation because the illicit market doesn't have to pay that cost. So it can be an issue particularly for cultivators. And so, yeah, I mean, that's part of the issue with this. OCM, doesn't have any control over this. It's legislated. So the only way to change it is through an amendment, through legislation.
Yeah, just to kind of weigh in on that real quick, like on the potency tax for flower at the 0.005 per milligram, I just want to, I've had this conversation and people are shocked when I say this and they think I'm not right. But what it breaks down to is it looks like a minuscule number, but it really isn't. So this year, as cultivators are able to self-distribute, if you're selling a pound of flower that's at 20% THC, it's about 200 milligrams per gram of THC per gram of flower, right? So when you multiply, that's about $1 a gram. It is exactly $1 a gram tax. So on that 1 pound of THC flower, you will have a tax of $454 that you have to hand over to the state. So on 1 pound of flower at 20% THC, that's a $454 tax on that. The higher your THC goes, the higher that tax is going to be.
Yep, that is absolutely correct. And I think, can you flip to the next slide, Nick? Yeah, so one of the other issues with this is this whole measurement of uncertainty. And as we saw in the proposed regs that came out, the laboratory regs, for those who are nerds and read them, you'll see that there is now the proposed independent sampling firm, which is a third-party firm that will come onto your property and do the testing, or not do the testing, do the sampling to go to a lab for testing, to try to mitigate gaming the system and things like that. But even this is right from Botanicor, no matter how precise the lab is, there's always going to be some uncertainty. And then the question is that ever going to have to be trued up at some point? Or is it going to be over or under? What is that? So it's a complicated process. And this is the first in the nation, really. Maybe Connecticut will beat us by a little bit, but it's pretty much untested water of taxing based on THC. So there's going to be a learning curve. There's going to be bumps in the road. I mean, the conditional cultivator license was probably one of the easiest licenses to apply for and get, and that's had bumps in the road. So this is very complicated. So I would expect there will be some issues as we kind of sort all of this stuff out going into the future. So some other issues, it's going to be expensive. You have the sampling firms, you have the lab tests. It's going to depend a lot on how big the batches are. So in Massachusetts, they do 10-pound batches. In California, they do like 100-pound batches. So if if we look like Massachusetts, you're going to have to test 10 times more often than California. And then the one of the theories this whole THC tax was based on was promoting temperance. This came from when Governor Cuomo was proposing this under the CRTA, and they believe that, like alcohol, if you tax higher concentrated or higher THC products at a higher rate, that people will consume less of them. I'm of the personal belief that that's probably not the case, because there's studies to actually show in alcohol it works, because it's easier to consume 4 shots than 4 beers. But with cannabis, it's not really the case. It's like 1 puff off a vape or 2.5 puffs off of a bowl. Like, that's not the same as consuming 4 shots versus 4 beers. So I don't think that promoting temperance argument really holds water, but that's my personal opinion. But that's the rationale. That's why we have it. That is literally why it was enacted. So that's just a little background on the New York State specific taxes and what you guys are kind of going to be in for insofar as collection responsibilities, and how that kind of ultimately affects your price at the end of the chain. Because though cultivators don't have to pay that tax, they have to realize that tax is going to be rolled into their product all the way down. And there's going to be a markup at retail. So it's not just going to be straight absorbed. It's probably going to be doubled. So just understand where that puts your price at retail. And then ultimately, not only are you competing with, other growers, but you're competing with the illicit market at the same time, who doesn't have to do any of this. So it's, we have yet to see how it's going to work out on the adult use side.
Yep. And then kind of just one last point on the THC potency tax, because this is an important thing when you're talking to your regulators and trying to get rid of this potentially in the future, because it doesn't make much sense. I think probably a lot of people on this call will probably agree it doesn't. When you talk about 280E and cost of goods sold expenses, we're going to get into what that means a little bit later. What this does is this actually creates a deductible expense for dispensaries, right? So not only does it compound the tax that's going to be at the retail tax, New York State is actually losing money from income taxes that they're going to be collecting from dispensaries, rather than getting rid of this and bumping up the tax at retail. So it's a good talking point when you're talking to your legislators that, if you just bump up to say 20% retail tax and call it a day, not only are you saving on operating cost, collecting more income taxes because those costs aren't incurred, and you're also getting rid of that. So it's actually in the state's best interest, in my opinion, to get rid of this tax and increase the retail tax from a revenue collection standpoint.
Absolutely agree. Okay, so on to something 280E related. So New York State, with the budget decoupled from 280E, good, because they hadn't done it for 7 years for the medical companies. Not that they were making profit to worry about it, but whatever, they hadn't done it. Problem, though, is the way it was written. So basically, it said for the production and distribution of adult use cannabis. And that was like the key phrase. So the first thing that tax people looked at was like, oh my God, does this not include retail? Which are the ones that are hammered hardest by 280E. If you're on the cultivation processing side, you can include, we'll discuss this, but you can include a lot more into cost of goods. Your tax rate might be, average 50, 60%, somewhere in that realm. If you're at retail, it can be more like 70 to 90% because your cost of goods bucket is a lot smaller. So we learned from legislators that the legislative intent was that distribution included retail. Now, as we kind of talked about at the beginning of the conversation, distribution does not include retail. Distribution is to retail. But the legislative intent is that. So NYCGPA, I believe, is going to try to ask for clarification on this issue, just to have some kind of guidance. Because, as I'm sure Nick will tell you as well, as professionals, we'd like to rely on something that's written somewhere instead of just thinking, well, we heard them say this and that was their intent. Yeah. So that's one of the issues that is trying to be addressed, is just making sure that retail is in fact included in this. It also seems to exclude medical, which is interesting. Not that it particularly matters right now because there's only the 10 licenses, but if that were to ever expand and be offered so that any kind of company could do a medical license, it would be an issue there too. So what are the effects of 280E? So just a little background really quickly on what 280E is. 280E was enacted, I think it was 1982 or something like that, where there was like this drug dealer that got caught, went to tax court because he took ordinary deductions. So like he had expenses, he deducted them. And the tax court said, yeah, you know what? He can do that. There's nothing that prevents it. So Congress did not like that at all. So they enacted 280E, which basically says you do not get any deductions or credits if you traffic in a controlled Schedule 1 or Schedule 2 controlled substance. So basically all you get is cost of goods. The overall effect is that the tax rates are very high, as I mentioned before. And part of the problem is, like, you know, people are kind of incentivized to try to get around this as much as they can, and that doesn't work well. Cannabis businesses are audited at a rate of 2 to 6 times higher than non-cannabis businesses. Why is that? Because, and this is from 2013, so I'm sure the numbers are even higher, but in 2013, data came out that a normal IRS audit produced, I think, around like $500 per hour worked by an agent. Cannabis businesses produce something like $1,200. So there's a reason that they audit these. And it's because they make a lot of money off of them. They also, you know, they know people are going to try to play games. It's all typically all cash. So it's not, it's easier to try to hide things than if it's all electronic and papered. So, you know, you really have to be careful in this area because the odds of you getting audited are very high. Yeah, I mean, as the slide said, you're audited at a rate that is like you're $100 million company. And so, I mean, it's a big deal. 280E is probably one of the most brutal aspects of the tax code. And it really, really takes a toll on cannabis businesses, particularly on the retail end, but even the cultivators are affected by it because, like, as we'll get into further, like things like your sales calls, your sales team, your CFO's salary, things like that, non-deductible. So it's a problem.
One thing I'll add to that too, the good news is the IRS cannot even open their mail on time right now. So hopefully they will have less time to audit businesses, especially in New York as we get going here. But that is not to say you should be more aggressive in banking on that. But just saying, the IRS has less time on their hands.
That is true. They do have a massive backlog. All right, so Nick is going to kind of handle this portion.
Yep. So this is really, you know, just the point of this slide is because, you know, a lot of other states are, you know, require vertical integration, right? But New York State has kind of gone another direction and tried to piece out this marketplace, right? So when you're a vertically integrated company, you know, sort of the hit on the retail side is a little bit less because you don't have as much impact at, say, you know, the cultivation and processing side of things because you're vertically integrated. So, you know, that's obviously good, in my opinion, that, you know, New York State's trying to piece out the market, let more people get a little bit of piece of the pie, but it does create this issue that, you know, retailers only, there's not much that you can do. We can get a little bit creative as far as, you know, accounting policies and, like, you know, cost allocations and things that we'll get a little bit into. But, you know, just something to be mindful of. I mean, it is not uncertain for, like, say, a retailer, first year operation, you know, typically first year operations, you get a lot of startup costs. I mean, there's a super big chance if you don't manage your non-deductible expenses as a retailer, you could owe more in taxes than you have in your bank account. It has happened. So it's very important for budgeting and planning purposes. So this is just kind of a little bit of an example, you know, this was sort of geared toward another state. So when it says like, you know, producer, I would say more, think of that as a cultivator type thing. Just to give you an idea of really all the same, and the impacts, because retail can't deduct a lot of generally has more general / selling expenses that they can't deduct. Whereas a producer processor, obviously a lot of your costs are going into creating that product through direct cost and getting wrapped up into your inventory. So just a general example of kind of the same, if you're looking at all these 3 layers of companies, they're each doing separate things. At the end of the day, the retailer only has $25,000 net cash take home. The producer and processor have triple and 4 times that. Just a quick example. All right, so let's get into like just 280E costs in general. You have your direct cost, right? Anything that goes in your production of your equipment. I mean, you got your nutrients, you got your grow lights, you got your soil, all those things that really are going into the production of that product. That's really the no-brainer where you can take this. I guess I'm gearing this more toward a cultivator, right at this
Would
point.
tractors fall in that too, like that sort of equipment?
Yep.
All
Yeah,
right.
as long as I guess, yeah, the only really like piece of equipment probably that I could think off the top of your head would be something like, say, a transportation vehicle for distributing. That's a selling expense, not a production, right? That vehicle that's transporting it from point A to point B, you're not using that to produce your product, you're using it to sell your product. Okay. So direct costs are kind of like the no-brainer. And then that's where it gets very gray. And also what I tell my clients is, what's your risk tolerance? Okay. There's, with gray area in tax law also comes opportunity, right? Because if they haven't told you flat out that you can't do it, you might be able to push the button a little bit. But obviously there's always a chance that the IRS is going to come in, disagree with you, and but as long as you have your ducks in a row, really the goal when it comes to, if you want to be, how I say, aggressive or even semi-aggressive, it's really having your ducks in a row and having your arguments ready. You don't want to get audited and then after the fact be trying to scramble all your documentation and put it together. A big thing with this is consistency, right? So if you're taking these stances and creating these accounting policies that you're following, you have to be consistent with them. Because if you're not consistent with them and you're trying to argue something, the IRS is simply going to say, you're making this argument, but you didn't even consistently follow your own argument. So we're not even going to listen to your argument. But if you're consistent, you have a good argument, there's less of a chance that they're going to go further or, potentially even make a small settlement. And then let's say, okay, we're good with that. And then that saves us a lot in court fees and going to tax court. Typically the IRS, the ones that go to tax court, they handpick those tax court cases. Okay. They are picking the people who really screwed up that the IRS knows that they're going to win, because then that also adds more ammo for when they're auditing future companies, right? A lot of the people who have their ducks in a row don't make it to tax court cases. And that's why we see all the tax court cases are the really bad situations where people just simply didn't do what they were supposed to do. Just like a quick direct cost, how it relates to a retail dispensary, pro rata percentage based on square footprint. So say you have a retail dispensary that is also selling other products. You're selling, CBD products. You're selling maybe an apparel line in there too. There's some things we can do. It's not that straightforward. There's a couple other hoops you got to jump through. But it's a way to really get some of those non-deductible costs into a deductible cost, as a retailer. But generally just cultivators have a lot more options of what they can do and kind of push the button a little bit. Retailers, there's only so much we can do. But there is some opportunities there. And then kind of how I alluded to too is even with cultivators, like some of these general and selling expenses. We'll get into this a little bit later, whereas, you know, you can kind of push the button. And as I tell my clients, that's not my decision to say what you should deduct or not, right? That's you as in a risk tolerance perspective. I'm presenting the information to the IRS. Really, it's up to you how much you want to push the button and what you want to deduct and how risk tolerant you are.
Yeah, and at our firm, you know, the way we would typically do it is if you asked us if you could do something and you wanted an opinion on it, we would write an opinion and kind of give you a spectrum of answers of this is the incredibly safe and, you know, you shouldn't have any kind of issues here versus this is where you're absolutely going to run afoul of the law. And then you kind of, you know, determine what your risk tolerance is, or as I said to Nick earlier, like how well you can sleep for the next 3 years before the statute of limitations on auditing your tax return runs. And that's kind of up to you. And, you know, being professionals, both of us will CYA and make it your decision. We will put the information in your hands and say, these are the risks.
So, gentlemen, we have one question that pertained to what we just spoke about from Paul Elfstrom. Would all of that 280E stuff go away if the U.S. Senate passes safe banking?
No, safe banking has nothing to do with 280E. It's literally just taking the reporting requirements for suspicious transactions, like any transaction that's $10,000 or more in cash or a series of transactions, all the compliance reporting on top of that. Has no effect on 280E. The only thing that can do it would be an amendment that says it doesn't apply to cannabis businesses in states where it's legal, or if they descheduled it, meaning either they took it completely off the schedule, which would be the better case, or if they dropped it to a schedule 3, 4, or 5, but that would not be good because that puts it firmly within the FDA's purview and they will wreck it like they have the CBD market. So that would be a terrible option. That's really it. Other than that, we're stuck with it.
Thank you.
All right, entity considerations. All right, so how important is this and is restructuring needed? We're going to go over a couple options for entities. You know, corporation. Usually in most industries, a corporation, otherwise known as the C Corp, as a lot of accountants call it, there's a double taxation. You know, it's the profit of the business pays taxes, and then the shareholders also pay taxes when they distribute funds from the business. So why this is very attractive for a cannabis company is back in 2018, when the big overhaul of the tax code happened, the top tax rate for a C Corp dropped from 35% and it went to a 21% flat size. So a couple other considerations is payroll for owners. You know, how much are you paying your owners? Are they passive, non-passive investors? Because that, you know, some of those wages might not be deductible, and it, you know, kind of creates, you know, with a C corporation, the IRS isn't coming in and saying, are you paying yourself enough W-2 wages? Because you already have that 2-layer of taxation. So they're not really looking at that when it comes to a C Corp when you get audited. Another thing is state tax considerations, 280E conformity, right? So 280E conformity, you know, we have those kind of unknowns right now, but, you know, hopefully those will get cleared up. And then the reason I want to bring this up too, because you have a lot of, you know, West Coast, you know, firms and Colorado coming over, you know, and have been doing things in other states like how they've always been doing, right? With these like vertically integrated companies and, you know, all this stuff where that might not work in New York State because New York State is a whole tax law on its own, right? New York State has a lot of benefits when it comes to agricultural and manufacturing. So when it comes to this double taxation of a C Corp, a lot of that can be sort of trued up at a state level, right? Where your state, that double, you're not really almost paying double taxation. I have a lot of manufacturers who do not pay any taxes state taxes at a C corp level. So, you know, when you're only talking about double taxation at the federal level, that makes the analysis a little bit bigger or a little bit better. The big question I always ask my clients when I first talk to them, what's your plan in 5 years? We won't get too much into like this details. There's some hurdles around this. It's called Section 1202 stock gain exclusion. Basically, it's geared towards small businesses that you've owned stock in a company for 5 years. If you eventually sell the stock of that company, there's an opportunity to 100% exclude that gain personally for what you sold that company for. So if your plan is to get out in 5+ years, that makes C Corp looks a lot better, even though you might be paying that double taxation for a few years. And then another big one is reinvestment of profits versus dividends, right? If you're starting a company and you're going to reinvest all those profits back into the business and expand your business, well, you just solved your double taxation problem because you're not distributing out any money. You're only paying that 21% flat tax rate and you're done until you start actually taking dividends from the company. And then another big thing too is also this kind of wraps into aggressive tax planning. You know, when you're a C corporation, you've now created that when the IRS audits you, they are auditing this corporation who's paying taxes, right? When you're an LLC or an S corp, that tax liability transfers to you personally. So when you talk about if you want to be aggressive too, that might also be another reason to be a C corporation, because that tax liability, if you eventually get audited, is on the C corp, not you personally. All right, then now we'll get into pass-through entities, partnerships, S corps, and Schedule C. Schedule C pretty much means if you're like, say, a single member LLC, 100% owner, that's what you would file as part of your personal tax return. Another thing in the 2018 tax law is a 20% deduction on qualified business income. There's nothing that suggests that cannabis income doesn't qualify for this 20% deduction. There are some limitations that phase in with taking that 20%. But basically those limitations are really stemmed to how much wages you pay your employer. Cannabis companies are obviously a huge labor intensive business. So usually those limitations aren't an issue, but it's also something to keep in mind if you're, say, 1099ing a lot of your workers. And there's a fine line of if you're 1099ing and you might be wanting to skirt like payroll taxes and stuff, you could be kind of kicking yourself in the butt if you do that too much. Not only would you potentially be liable to owe some payroll taxes if the IRS disagrees with you, but also you could be limiting yourself on this deduction, and it's really just analyzing it. And then just an important note, I mean, we touched on, some of the big things, but there are a lot of other considerations that, kind of go into entity structuring and, just choosing what's best for you. And as always, we're always dealing with projections too. So, and I guess the one other thing I would say with that also is, change in tax law, right? There's a lot of talks at raising that C corporation rate back up at the federal level in Congress right now. So just the answer today might not be the answer tomorrow, right? I did a lot of restructuring with my clients back in 2018 when all this tax law, because everything changed, right? We needed to reanalyze every single business that we had to make sure that we didn't want to change around how they were taxed just because there were so many changes in the tax law. All right, so miscellaneous considerations. So I've heard this come up a lot. Different entities for different activities. There's a lot of reasons for this, not only for tax purposes, because you don't want your non-THC touching businesses involved in your non-THC touching businesses and potentially subjecting those businesses to 280E2. So it's always a good idea to, separate entities for different activities. Big thing for that is insurance. You'll run into where your insurance company might be insuring your hemp or your vegetable farming business, but they might not necessarily want to insure your THC business and vice versa. Payroll, that's more also of a tracking thing. A lot of companies will have what's called shared payroll through entities, but really it's a tracking of what payroll is being allocated to what entity, right? So another, even aside from having different lines of business, like say you get a CBD company and a THC company, there's tracking the difference of what wages are related to those two companies. But then there's also a tracking of payroll issue inside a THC plant touching business, right? So a lot of small businesses, sometimes you're not going to just have workers who are just out there mending your fields every day, right? You could have people who they have a dual role of going and working on your fields and producing those products, but then they also might be going in the back office and calling dispensaries and trying to sell your products too. So timesheets are a huge thing, and tracking, because if you don't have documentation, when the IRS comes and looks at this, they will assume the worst possible case scenario and they will subject it all to 280E and say it's non-deductible because you didn't track it. The burden of proof is on the taxpayer, not the IRS.
Yep. Once they make the allegation, you have to prove them wrong. And if you don't have the records, that's going to be very tough.
And then another big one's banking. Same thing, same idea. You have a bank, you're working with banks right now. They might not necessarily want to touch your THC plant touching stuff. So another reason to separate out the entities so that you can keep your bank with your other entity, because banking is going to be more expensive when it comes to THC plant touching. This is just something because it's more recent, the DEA opinion on seeds not being THC products. I'm still kind of digging into this too. It was just kind of an idea is, does this open up the door for, say, selling clones? Are clones subject to 280E? Are they above 0.3%? Not to say the DEA is anything authoritative, but there are, in a lot of these court cases with the IRS actually cites the DEA a lot. So, I think this is untested waters. Let me put it that way. But, I think that this kind of opens the door to, maybe if you're selling products, like say you are a nursery license and all you do is sell clones and those plants never reach 0.3%. Are you subject to 280 at all? I don't know for sure, but just an idea. Different state licensing rules. Obviously, this kind of goes back to, what has worked in other states might not necessarily work in this state. A lot of other states are vertically integrated. Our supply chain is completely different. A lot of different considerations where what might have been tax strategy in other states might not work in our state, just because of the way that we're trying to set up this marketplace. So IRC code section 471 and 263A. This is what people use as cultivators to get more costs into cost of goods sold that without these accounting methods would otherwise not be available. Okay. Pretty much generally, GAP stands for generally accepted accounting principles. So same thing, you got to have your ducks in a row. You got to have your accounting policies in place. And there is some opportunity for the risk tolerant to get some aggressive stances in there, but I'm going to repeat it just because it's so important. Consistency, right? And this also goes to starting off on the right foot, because you want to create your accounting policies, you want to stick to them and be consistent, because then you have an argument when the IRS comes around and they're less likely to push the button further. Oh, I kind of already brought this up earlier. Tax changes in Congress. You know, what's the answer today might not necessarily be the answer tomorrow. Tax law always changes. You know, typically tax law changes happen in December. They can happen earlier, but they usually do it last minute on us. And then process for any structuring changes with OCM. Jason, do you want to talk on this? I think that this is a big issue that you know more about.
So we don't have real guidance on it yet, but if you're in the kind of situation that Nick talked about, where, you know, maybe you applied for your conditional under your federally legal business and you're like, oh my God, I'm going to lose banking or insurance. How do you deal with it? So what we understand is that OCM will grant the ability to change the entity to a new entity. I would imagine the condition is everything has to remain identical. You're just literally changing the entity over to a separate thing to segregate out THC from federally legal. Again, there is no clear procedure. I imagine it has to do something with emailing licensing at OCM and giving them the details of the plan. And then from what I understand, they basically issue you a new license because that's how their software works. It's unclear whether the issuance of that new license is purely administrative or it would have to go back through to CCB. Don't know. They don't have any of these things published. So we're just kind of waiting to see how that all works out, but it is possible. And that's the point is, you know, if you applied under your federally legal business, you are not doomed. We can fix it. It's just the timeline of that and the exact mechanics, we're not entirely sure yet.
Jason, just to piggyback on that real quick, question came in as you were speaking. Are you saying, anonymous attendee asks, are you saying that different entities should be set up for plant versus non-plant touching businesses, but not as a way to try and avoid 280E?
What Nick and I specifically are talking about is, let's say you have a hemp business that is federally legal. You treat it like every other business under the sun. You can deduct everything. If you suddenly start running THC through that same business, you're going to create a mess that risks having the entire business subject to 280E.
Also losing banking in general for
Right.
your non-cannabis, your non-THC touching business.
Right.
Which falls into a second question that was asked earlier. Can we have a non-THC company do all payroll, then allocate this into a THC company as necessary? I feel like if a bank were to do due diligence, it'd fall into the same sort of category, right?
Yeah, and you're not going to save any taxes by doing that or anything like that, because the costs are going to be deductible or not based on what they're doing. So, I mean, you know, that's really all you're going to, they're going to do their due diligence, just like Eric said. I mean, they're going to look through these entities, banks, payroll, insurance. They're not dumb. They figure it out eventually. So it's best. And this is another thing to be upfront. Like, you don't want to be in the situation where you think you're going to get something by them. They figure it out and drop you that day. You want to find the people who will work with you and set it up properly.
Yeah, I just had a colleague who was awarded a license, and her bank found out and immediately shut down banking to her nonprofit organization because she's now THC touching. Didn't even try to open a bank account. They just said, you have a THC license, all of your businesses, including your nonprofit, are done. Yeah, so guys, that is probably the biggest reason for the split. And Jason, I did file a new entity before we applied for the license. And yeah, it's very straightforward and clear in the OCM, as you mentioned. Has to be the same exact ownership structure.
Yeah.
And one question from the last slide that I got a little delayed on. Does the agriculture farming exclusion of 1202 apply to cultivators?
Yes.
All right.
It applies to any C corporation. I haven't, Jason and I actually looked at this. So 1202, it doesn't really matter what business you are. I'm under the opinion that 1202 any business that's taxed as a C corp can take the 1202 exclusion when they ultimately sell that stock. Yep. And and just one more thing on the payroll too, because I do think that this is really important too, because a lot of companies will have the shared payroll, right? Because it's a decrease in cost if you keep all your payroll under one company. But I guess I would say to that, like, yes, it is possible, but you run into those banking issues because now you're running THC payroll through a non-THC business. But what's more expensive? Paying for two payroll processors in two separate businesses, or potentially losing your banking? I'd be willing to bet it's probably losing your banking. So yeah. All right, so now we're gonna quickly go over the one Q&A question that was submitted before. All right, so can fences, high tunnels that are cannabis touching be written off and all, or actually let's break this down into two things. So we're gonna start with Jason and I didn't really know what wording for MOI of cannabis touching workers. We didn't really know what that means. But so we're going to skip over that unless the person who asked that question happens to be on and doesn't mind clarifying on that. So let's start with the easy ones. Fertilizer, seeds, cannabis touching drip tape, irrigation pipes and valves. So these are all cost of productions. That's not to say that some of these things won't be capitalized and depreciated, similar to, these, the depreciation life over 7 years. I'm going to get to the tractor and depreciation life on the next slide. So there was also a request for a write-off of list of write-offable expenses. So kind of going back to what we said earlier, there is no list of write-offable expenses because it depends how aggressive you want to be, right? So I can't give you a list and say this is what, there's the easy ones, the direct costs that are clearly production. Those are easy. We could probably create a list of those, which would be sort of like fertilizer, seeds, anything that goes directly into the production of goods. But then once you get past those no-brainer direct costs, then that's where the gray area comes in and kind of what your risk tolerance type thing is. Cost to test by labs, the general rule of thumb is when you're producing products, anything that's needed before sale would be a cost of goods sold expense. So your lab testing, Jason, what was the other thing that you brought up earlier?
Oh, the sampling firm? Is that it?
Yeah. So those are all required, right, before you're selling this product. So those would all be write-offable cost, in my opinion. So now to touch on like the tractor and the depreciation, a little bit of a guide on some of the big items here on this next slide. All right. So established accounting method. This kind of wraps into this. If you're using one of those cost absorption methods, you need to have a capitalization policy in place. There's what's called, from a tax world, it's the de minimis expensing election. Anything that costs under $2,500 per item, you can write off. And then if you have an applicable financial statement, which basically means an audited or reviewed financial statement for a government body and or for a creditor or a shareholder partner reporting purposes, that bumps up to $5,000. So this is like a per item on an invoice basis. So say you bought 20 grow lights and they were all $2,499 a pop, all write-offable. You don't have to capitalize and depreciate them. But when you're using inventory of full cost absorption, you're going to have to capture some of that back into your inventory. So you're not really going to be able to deduct it until whatever you applied to that inventory is ultimately sold. But you also don't have to capitalize and depreciate it, over the life of the year. So also what is pretty clear in court cases that we have is a lot of other businesses, like for instance, in the construction industry, I work in that industry a lot. You buy a piece of $100,000 excavator, you get the benefit of writing that entire $100,000 off in the first year, and you're going to get use of that for 10 years, right? But if you're using this full absorption inventory accounting method, basically what it says is your income needs to kind of properly match what your expenses are. So what that basically means is those first year write-off tax codes that a lot of other businesses take advantage of, if you're using this method, you're not going to be able to just write off all your equipment in the first year. So some general what is sort of industry standard. Farm equipment in general is a 10-year depreciation life. Trucks and automobiles are a 5-year life. The reason I bring up caveat to this, transportation or production, right? Are you using a truck on your field to move cannabis around and move tools around and do work that is going into the production? Or is it a truck or automobile that is using to distribute, right? There's a difference there. One's a selling expense, one is a direct cost of goods sold expense into your production. Land improvements, I threw this in there because there was, I think on the question like irrigation and things, that would probably fall under the category of land improvements. It's a 20-year life. And then also when it comes to gap depreciation, just straight line depreciation, you get 1/20th, say, of land improvement for the next 20 years. You also, there's a little bit of a flexibility here, right? If you buy something and you think it's a land improvement and it's got a 20-year standard life, but you think it's only going to last you 10 years, you can use your lower useful life, but you got to have that in your kind of established accounting methods. So I bring up document because you don't want to be throwing this together when you get audited. You want to have this ready to go and present it to the auditor immediately when they request it. And then back to consistency. You got to stay consistent with it. You can't just be changing around your useful lives year to year. And then I just said document it again, just to drive that home, because that's important. And then, all right, so I think we're ready for open Q&A.
Yeah, if anybody, Zach, is there a way to do like live answering here, live questions? I'm sorry.
Live meaning like we can call on someone to speak, or right? It seems like right now the best way folks can ask questions is through the chat and the Q&A. I don't have particular particular ability. Yep.
If anybody has any questions, we have about 15 minutes to answer. So please feel free to throw them in the Q&A, and hopefully we can answer them. Nick and Jason are wizards, and I'm sure they'll be able to answer most of them. So
I guess too, when we're while we're waiting for questions to roll in too, as you can see, there was one question submitted, and I know that there's talks about potentially like making it into this series because this is a big topic and there's a lot of stuff that we sort of breezed over that we could probably do a whole webinar in just one little bullet point that we sort of breezed over. We created a whole slide for that pre-submitted question. So so if everyone pre-submits questions, it will get attended to more, and you might get a more encompassing answer on it too, just for future reference.
And that question was when you read with the registration email, it was submitted. So, we're going to keep that question open. So if you do have any questions and you want a little more insight, as Nick said, please, kind of go back into the email, submit your question, be as detailed as possible. And we will do our best to make sure to answer it. Jacqueline Ferraro just wanted to say thank you for putting this together. You guys are very knowledgeable. Like I said, Nick and Jason are the best here. Kate Miller, I came in a little late. What rate is biomass being taxed at under the MRTA?
0.5 cent per
milligram. Yeah, so biomass is a little bit of an interesting one. Guys, please correct me if I'm wrong, but I think I have a handle on this one. So biomass, we would be selling to the processors because we can't do anything with the biomass other than have it made into, distillate or whatever kind of concentrate it's supposed to be. That being said, as the cultivator, we would not be responsible for the tax on that in any way, and that would be taxed on the milligram of the concentrate it's made into by, or rather the processor would be responsible for the taxes on the products made from the biomass. So the cultivator technically wouldn't be taxed on the biomass. Is that correct?
Yeah. If it's not going to retail, then you're not paying. It's when it goes to retail is when the tax is accrued. So in that specific circumstance, you are correct.
Yeah. Two, kind of looking in the future, just because that is important too. Because obviously a lot of entities are going to be self-distributing for these conditional cultivator licenses. But then when you have, when the full license application process goes and you have folks who are just going to be cultivating, maybe just processing and not distributing, that's also a big business consideration too, where, I know a lot of people want to, it sounds good talking out loud with I want to do cultivation, processing, and distribution. Well, you also just created a lot of cost for yourself too. So when it comes to outsourcing distribution, take a hard look at that. It's not just buying trucks and doing that. It's dealing with this THC tax thing too, where it might make more sense in a lot of cases to outsource your distribution. It's just, so be mindful of that it's might not be as small of a cost as you might think off the first hand.
Right, so we have,
just so you, Eric, there's a couple questions in the chat coming through
yeah,
too,
I was
folks.
just about to get to those.
You got it. Thank you.
So Jacqueline asks, can you speak about leasing employees from a related non-canna business if those employees are shared?
I mean, you can, you're going to run into essentially the same issues of, are they deductible costs or not? Are they plant touching? What are they doing? So you still got to do all the record keeping. And this is something I was going to kind of bring up if there was a lull in the questions, was there's this concept that the IRS has called transfer pricing. So this is the IRS's way of people playing games with prices. So let's say that you have this employee business where you're going to lease them over, but normally your employee, it's $20 an hour, whatever, $30 an hour, make a bigger difference, $30 an hour. And that's the normal price. But instead you're going to drop that down and you're only going to charge the cannabis business $15 an hour to do their sales stuff because you want to lower those non-deductible expenses. The IRS could hypothetically come in and use transfer pricing and say, that's not the real cost. You're pushing the cost away from a 280E business into a non-280E business. We don't buy that, and we're going to actually raise the price on you. So you do have to be careful of trying to play any kind of game like that. You can lease the employees, but it's got to be for that market rate because the IRS, as we said, you're probably going to get audited at some point, and the IRS will look into those things, particularly when it's a related entity, because then if it's a third party unrelated, then that's a market rate deal. Like each party had opposing interests and you came to an agreement. The IRS can't really attack that. When it's related parties, they will attack that because then they're just going to say, we know what you were doing here.
Mm-hmm. Basically, the kind of sniff test that I tell people, is there an economic substance to what you're doing? If there isn't, and it's just to try to skirt 280E, it's not going to hold up. There's no economic. You would never do that, right? You would never pay employees $30 an hour and lease them to another company for half of it. You wouldn't do that. There's no economic substance to it. Doesn't make sense.
And then Jacqueline had a follow-up question. What is your opinion on 280E being applicable to landlords leasing property to cannabis entities?
As long as it's an unrelated third party, they're not subjected to 280E.
Yeah.
Company. But now if you're in a self-rental situation, same deal. A lot of people have tried to test the waters where They set up, you know, I mean, a lot of companies put their real estate in another entity just for legal liability separation and stuff too. But same deal, you know, if you're setting up this real estate entity because you want to deduct all your utilities and your real estate taxes and your interest and all that good stuff, and you're charging a rent price that is 40% of what you would actually charge for rent to cover your cash flow so that you can take losses over on your real estate company, again, no economic substance. So if it's just completely unrelated third party and stuff, the landlord does not have to worry about 280E. It's just like any other rental income. It doesn't matter if it's to a plant touching business, like say a dispensary.
And we have another question in the Q&A from Anonymous. Can you clarify how New York State helped out with 280E with their amendment that was made? Please use a monetary example if possible. Thank you.
They decoupled. So hypothetically, if we're all right and the legislator's intent goes through, it includes production and retail. So for example, if you had $100,000 in revenue and you had $80,000 of expenses, you're only going to be taxed on 20 grand. And it doesn't matter what those expenses are, as long as they're ordinary and necessary business expenses, you get that deduction for those expenses. Unlike the federal side of things, where let's say of that 80 grand, only 40 grand of that was cost of goods, and the other 40 was non-deductible expenses. So despite the fact that you only have $20,000 in your hand at the end of the year because you paid 80 grand in expenses, the IRS is going to say, no. You have a profit of 60 grand. So you owe us, call it 30% of 60 grand. So that's like $18,000. So at the end of the year, you're going to have 2 grand. That's the difference. Now, the issue though, is that though it helps, because obviously getting to deduct things helps, New York State is a very small component of your taxes. The feds have tax rates up to 37%. New York State, most people are going to be up to like just below 7%. If your income is in the millions, you can get up to like, I think it's like 11% or something like that. But, we're talking 5-6%. So it helps, but you're just still killed by the federal side of things.
I guess I would add to that though, unless you're in New York City, you get above 10% too, if you figure in that New York City tax stuff too.
Yes.
Yeah.
Taxes.
And then
real-
also too,
Right.
just one more point to that too. We are the second highest taxing state in the country, right? The only one that beat us is California. So I guess I would say to that too. California took, I think, 5 years after legalization to pass this 280E bill. It is a huge reason why they are having an issue getting legacy folks to go into the regulated market, because their tax rate, I think New York State tax rates are bad. California is worse, and it's good that it's fantastic that New York State got this done before the industry got going.
It leaves us about 5 more minutes. It doesn't seem like we have any other questions coming in. Yeah, this whole talk gave me anxiety. I'm gonna be honest. There's a lot to unpack here, but please, like I said before to everybody, please, if you do have any pertinent questions, please submit them to that questionnaire. Because as you can see, as Nick had mentioned, he dedicated an entire slide to the one question we did receive. So moving forward, there's a lot to unpack here. We barely scratched the surface. As Nick said, one bullet point can be an entire webinar. So the more questions, the better. As we get, Michael, no problem. Thank you for joining us. Appreciate it. And that's it. Yeah, no more questions. Zach?
One thing I would add, because I've seen this with my clients, is make sure that when you're doing your financial projections, you're taking into account the taxes, because I have seen people that don't. And then we discuss this stuff and they're like, oh my God, that entirely changes the calculus, and it does. So make sure that that's part of the numbers that you're figuring out.
Especially with that milligram tax on THC. You know, like I've used 20% THC as an example, just because it's kind of a middle of the road. So now imagine you are, you know, right, high THC TAC, as other states say, total active cannabinoids. That is what people actively look at in dispensaries. So rather than looking for terpenes, which is my favorite, most people look for high THC potency or high THC flower in a dispensary. So if you're a cultivator and you want to put out that gas that's at 35% THC, you know, just remember you're going to be pushing over $600 in taxes for that 1 pound, not to mention the cost of goods and everything that went into it. It was probably going to cost you, you know, a bit of money to produce it. So now the higher your THC goes, your potential input to that pound, or how much it costs you to produce that pound with, you know, labor, nutrients, general cost of goods, plus that tax, you're looking at nearly $1,000 to generate that 1 pound of flower. So, you know, be wise when you're cultivating, and remember that, especially this first year, like, we as cultivators are responsible for handing that money over to the state.
Do we know, quick question too, actually, do we know who's submitting for lab testing? Is it the cultivators that get to send in a sample, or
No, it's the sampling labs.
they come and pick?
Yep, it's to take the cultivators completely out of the equation. The sampling labs, the way the proposed regs, I mean, hypothetically, could it change? Will it? I don't think so. But the sampling firms are going to come in there. They are going to be videoed the entire time. An employee from the cultivator will be present, but they cannot interact. They can't touch. They can't do anything. And they sample. They put it in bags. Everything is signed off by both the employee and the sampling firm, chain of custody. And then you have to keep the video for like 90 days, I think it is. And then it's sent off to the lab.
Is that just for potency?
I think that's going to be for everything. I think that's going to be,
So
I mean,
they're going to take a wet sample, put it into a bag, ship it or send it to a lab where it's going to bake in a car at 80, 90, 100 degrees and just develop a whole lot of microbials on the way.
Part of the problem is we don't know, because I was looking for that kind of stuff of like the specifics. The lab regs are very general insofar as this is the procedure for the sampling. Yeah. I think that kind of question is going, and what batches are and things like that are going to be in real cultivation regs.
Yes.
And I think that's where it's going to be.
But yeah, because if that's testing for everything, like, it's going to be a whole lot of microbials growing on the way to that lab.
Yeah. Well, I was also more thinking in terms of, are they taking it from the top of the plant, or are they taking it from the bottom of the plant?
So that is why I believe they're having this. They're going to take the cuttings from the top of the plant, right? Because I know in other states, like, to get around some states that have THC taxes, cultivators will take, like, you know, lower, less prominent nugs, hoping that it's a bit of a lower THC content. But then there's other states that kind of pad and cushion their COAs to sell. So those are non-THC tax states, but testing's a big hurdle nationwide. Every rec state deals with testing issues, and it's just something we need to be prepared for.
Yeah, but at the same time, then if they're taking it from the top of the plant, now you're overpaying taxes on whatever's at the bottom of that plant that we all know has lower THC.
Yeah, so I would hope they design some sort of homogenization method where they take equal weight from the top to bottom, so on and so forth. But they're going to want their taxes. So. And I think that is 7 p.m. I think we're good. No more questions. I just want to thank Jason and Nick for putting together this whole workshop, spreadsheet and everything. Appreciate you guys. Looking forward to, you know, continuing working with the policy committee along with the education committee. And thank you for everyone who joined. Much appreciated, and please, you know, stay in the loop. We will be bringing out more webinars in the upcoming weeks.
Awesome. Thanks for having us, guys.
Thanks.
No problem. Have a great night, everybody.